All right, let's dive in. Today, we are pulling back the curtain on a number that every single investor needs to know, but honestly, a lot of people just gloss over. It's the secret ingredient that decides what you actually get to keep when you sell a stock for a profit. Let's get right into it. So picture this. You made a great trade, you're seeing that profit pop up in your account, and you're feeling on top of the world. But then you remember the tax man. So how do you even begin to figure out how much of that gain is actually taxable? It can feel like a real mystery, can it? Well, the key that unlocks that whole mystery, the absolute foundation of your real take-home profit, it all comes down to just two little words: cost basis. And today, we're going to make sure you walk away understanding this thing inside and out. Okay, so let's start at the very beginning. Calculating your cost basis is, believe it or not, pretty straightforward once you know the rule. It really all comes back to where you started. So what is it? At its heart, cost basis is simply the total amount of cash you put in to get an asset. That's it. Think of it like the original price tag. It includes the purchase price and any of those annoying little fees or commissions you paid to make the trade. It's your starting line. Now, to make this crystal clear, we're going to follow one single investment from the day we buy it all the way through. Let's pretend we're investing in a made-up company we'll call ABC Inc. And let's say you invest $10,000. This is your total stake, the full amount you've decided to put into ABC Inc. And for that $10,000, you're able to buy exactly 1,000 shares. Simple enough. You are now officially a part owner of ABC Inc. So here's the magic moment. Your cost basis per share is $10. You just take your total investment, that $10,000, and divide it by the number of shares you bought, 1,000. That $10 figure, that is your anchor point for everything else that's about to happen. And why do we care so much about this $10 number? Because this is the starting line as far as the IRS is concerned. When you go to sell, your taxable gain isn't the total sale price. No, it's the sale price minus this cost basis. Without this number, you are flying completely blind at tax time. It is absolutely fundamental. Okay, but investing is rarely that simple, right? Your journey can have a few twists and turns that will actually change your cost basis. But don't worry, the rules for handling these little adjustments are just as clear. All right, so check this out. Let's say ABC Inc. announces a 2-for-1 stock split. All of a sudden, you have double the shares, 2,000 of them. But, and this is the key, notice what happens to your cost basis per share. It gets sliced right in half, from $10 down to $5. The big takeaway here, your total investment value, your total basis stays exactly the same at $10,000. You just have more slices of the same pie. Now, this happens all the time. After you buy your first block of shares, the market takes a dip. ABC stock falls to $5 a share. You see this as a great buying opportunity, so you invest another 10 grand. This time, it gets you 2,000 more shares at that much lower price. So now you own 3,000 shares in total, but, and here's the catch, you bought them at two very different price points. So what happens when you want to sell some? And that brings us to a super important question. Which shares are you actually selling? The $10 ones or the $5 ones? Thankfully, the IRS has some very clear rules of the road for this exact situation. The default rule, the one the IRS uses unless you say otherwise, is called FIFO. It stands for first in, first out. And it's exactly what it sounds like. The government assumes you are selling the very first shares you ever bought. The oldest ones are the first to go out the door. And here is exactly how that plays out. Let's say you decide to sell 1,500 shares. Using FIFO, the first 1,000 shares you sell are considered to be from your initial purchase, the ones with the $10 cost basis. The next 500 shares you need come from your second purchase, and those use the $5 cost basis. This means your tax calculation is going to be based on this specific mix. Okay, we've covered the big ones, but there are a couple of special cases you really need to be aware of, especially for shares you get without buying them directly. Let's wrap up with those and our key takeaways. Now, this is a huge distinction. If someone gives you stock as a gift, you also get their original cost basis along with it. But if you inherit stock after someone passes away, something kind of magical happens for tax purposes. Your cost basis gets stepped up to whatever the market price was on the day they died. This is massive. It means all the gains that built up during the original owner's life are basically wiped clean for tax purposes. It's an incredibly important rule to know. So let's wrap this all up. At the end of the day, cost basis is just your original purchase price. It's the bedrock for figuring out your taxes. Just remember, things like stock splits and buying more shares will tweak your per share basis. And if you've been buying at different times, the default method is first in, first out. And of course, don't forget about those very different, very special rules for gifted and inherited shares. So now that you know about the hidden math behind your investments, it really makes you think, doesn't it? That big green number you see in your brokerage account, well, that's not the whole story. Your real performance is what's left after Uncle Sam takes his cut. Does knowing your cost basis change how you see your own portfolio's success? It's definitely something to chew on.